For centuries, investors have relied on a mix of intuition, experience, and traditional analysis to navigate the complex world of finance. We pore over charts, scrutinize financial statements, and follow market trends, all in pursuit of that elusive edge. Today, a powerful new tool is transforming the investment landscape: predictive analytics. This isn't about gazing into a crystal ball. Predictive analytics uses data, statistical algorithms, and machine learning to identify the likelihood of future outcomes. By analyzing historical data and identifying patterns, it provides investors with data-driven insights to make more informed decisions. Imagine predicting stock market movements, identifying promising startups, or even anticipating economic downturns with a higher degree of accuracy. This is the promise of predictive analytics, and it's already reshaping how we invest. As we delve deeper into the world of predictive analytics, we'll explore its core techniques, real-world applications, and the exciting possibilities it holds for the future of investing. The video is for educational and entertainment purposes only. It is not financial advice. Do your own research and do not invest more than what you can afford to lose. Predictive analytics isn't about fortune-telling. It's about using data to make educated guesses about the future. Think of it as a sophisticated form of forecasting, but instead of relying solely on expert opinions, it leverages the power of data and algorithms. At its core, predictive analytics involves three key steps. First, data collection, which means gathering relevant historical data, such as stock prices, economic indicators, or company performance metrics. Second, model building, using statistical techniques and machine learning algorithms to identify patterns and relationships within the data. And third, prediction, applying the trained model to new data to forecast future outcomes such as stock prices or market trends. Imagine trying to predict the winner of a basketball game. Predictive analytics would involve analyzing past game statistics, player performance, and even factors like team morale to calculate the probability of each team winning. In essence, predictive analytics helps us move from simply observing the past to anticipating the future, providing a valuable tool for investors seeking to make smarter decisions. Time series analysis is a fundamental technique in predictive analytics, particularly useful for understanding trends and patterns in data collected over time. Think of it as connecting the dots to reveal the bigger picture. Imagine tracking the price of a stock over a year. Time series analysis can identify seasonal patterns, upward or downward trends, and even cyclical fluctuations. By understanding these patterns, investors can make more informed decisions about buying or selling. For example, a retailer might use time series analysis to forecast sales during the holiday season based on historical data. By identifying peak shopping periods and predicting demand, they can optimize inventory and staffing levels. Time series analysis isn't just about looking backward. It also helps us forecast future values by extrapolating from existing patterns. While no prediction is foolproof, time series analysis provides a data-driven approach to understanding how things might change over time. Regression analysis is another powerful tool in the predictive analytics arsenal. It goes beyond simply identifying patterns in a single variable over time. It explores the relationships between multiple variables. Imagine you're trying to understand what drives the price of a particular stock. Regression analysis can help you quantify the impact of various factors, such as interest rates, industry trends, or even news sentiment. For example, a real estate investor might use regression analysis to determine the relationship between property prices, location, square footage, and amenities. By understanding these relationships, they can make more informed decisions about property valuations and investment opportunities. Regression analysis helps us answer questions like, how much will this stock price change if interest rates rise? Or what is the expected return on investment for a property with these specific characteristics? By uncovering these hidden relationships, regression analysis empowers investors to make more data-driven decisions, moving beyond intuition to a more quantitative approach. The AI revolution, machine learning, takes center stage. The emergence of artificial intelligence, particularly machine learning, has supercharged predictive analytics. Machine learning algorithms sift through massive datasets, identify complex patterns, and make predictions with remarkable accuracy. Unlike traditional methods, machine learning algorithms learn and adapt from data, continuously improving their accuracy. This AI-powered model could identify subtle correlations and predict market movements. The integration of AI into predictive analytics holds immense potential to revolutionize investing. Real-world applications, predictive analytics in the financial trenches. Predictive analytics is actively used by financial institutions, hedge funds, and individual investors to gain a competitive edge. High-frequency trading firms use complex algorithms to execute trades in fractions of a second. Banks use predictive models to assess creditworthiness, detect fraud, and manage risk exposure. Robo-advisors create personalized investment portfolios tailored to individual risk tolerance. Hedge funds use natural language processing to gauge market sentiment and predict stock price movements. Predictive analytics is transforming the financial landscape. The human element. Why intuition still matters. While predictive analytics transform investing, data is just one piece of the puzzle. Human judgment and intuition still play a crucial role. Predictive models are powerful, but not infallible. Unexpected events can disrupt even sophisticated models. This is where human intuition comes in. Experienced investors bring knowledge and understanding that algorithms can't replicate. Predictive analytics is evolving, driven by technology, data availability, and demand for insights. Key trends shaping predictive investing include alternative data sources like satellite imagery, social media sentiment, and weather patterns. Robo-advisors create personalized portfolios based on risk tolerance and goals. AI models demand transparency and explainability for trust. Quantum computing could revolutionize predictive analytics. The future of predictive investing is bright, driven by innovation. Embracing these trends will help investors thrive. The good news is that you don't need to be a data scientist or Wall Street quant to start incorporating predictive analytics into your investment strategy. A growing number of tools and resources are available to empower investors of all levels. Platforms like Betterment, Wealthfront, and Acorns offer automated portfolio management powered by predictive analytics, making it easy to get started with a data-driven approach. Companies like Bloomberg, FactSet, and Refinitiv provide access to vast amounts of financial data, including historical stock prices, economic indicators, and company fundamentals. Websites like Coursera, EDX, and DataCamp offer courses on data science, machine learning, and predictive analytics, providing a solid foundation for those looking to delve deeper. Programming languages like Python and R have extensive libraries dedicated to data analysis and machine learning, allowing more technically inclined investors to build their own predictive models. The key is to start small, experiment, and gradually incorporate predictive analytics into your investment process. As you gain experience and confidence, you can explore more sophisticated tools and techniques. While predictive analytics offers tremendous potential, it's crucial to approach it with a healthy dose of caution and a balanced perspective. Here are a few key risks to keep in mind. Models that are too closely tailored to historical data may fail to generalize well to new data, leading to inaccurate predictions. If the data used to train a model is biased or incomplete, the resulting predictions will also be flawed. Predictive models are generally poor at predicting rare or unprecedented events, such as financial crises or pandemics, which can significantly impact markets. Blindly following the recommendations of predictive models without understanding their limitations or considering other factors can lead to costly mistakes. It's essential to remember that predictive analytics is a tool, not a magic bullet. By understanding its limitations, mitigating risks, and combining data-driven insights with human judgment, investors can harness the power of predictive analytics while avoiding potential pitfalls. The integration of predictive analytics into the investment landscape is still in its early stages, but its impact is undeniable. As technology continues to advance and data becomes even more readily available, we can expect to see even more innovative applications emerge, further blurring the lines between traditional finance and data science. The future of investing belongs to those who embrace this evolution, who are willing to learn new skills, adapt to changing market dynamics, and leverage the power of data to make more informed decisions. While the road ahead may be filled with both opportunities and challenges, one thing is certain: predictive analytics is here to stay, and its influence on the world of finance will only continue to grow in the years to come. By embracing this transformation and approaching it with a balanced perspective, investors can navigate the complexities of the market with greater confidence and clarity, unlocking a world of possibilities in the exciting new era of data-driven finance. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.